Climate change and global warming are going to be the dominant issues we will deal with over the next 50 years.
A recent poll done by Environics International showed that 9 in 10 Canadians want the investment community to pay more attention to social and environmental factors when they're analyzing companies.
We look for companies that have more positives, whether it's for the environmental, social, and governance area, but also looking at positive financial outlooks as well.
The debate over environmental and climate change is over, and now we're moving on to action.
You hear people talking about it because it's in the media, and they start to wonder, well, what about my portfolio? It's a huge myth that you have to make a choice between I want to be a responsible investor or I want to make money, but I can't do both.
Investors are always looking for opportunity, and they're always looking for as much reward as they can get at the lowest risk. So in the sense that responsible investing lowers your risk, it should provide a good reward for investors.
Traditionally, we've defined risk as risk of an economic downturn, interest rate risk, inflation risk, all very financially oriented. But we're entering a new era, really, where it has to be a much broader definition, where we as investment managers have to be aware of environmental factors and climate change, obviously, hurricanes, carbon emissions. These are all new issues that are becoming a growing concern for us. And their effect is very real, for example, on commodity prices and, of course, on the financial well-being of companies.
Usually what happens in the investment world is the institutional community will lead trends. Maybe the biggest thing to point to is there's a thing called the Carbon Disclosure Project, which has about $40 trillion worth of investors that have signed on to it. That's the largest collective capital initiative in the entire world. I mean, for scale, Canada's GDP is just a little over 1.1 trillion. What it basically says is it's not just an issue for granola crunchers anymore, when you've got the Goldman Sachs and the Canadian Pension Plan Investment Board that are taking these issues seriously.
Companies that are more efficient, that are using less fossil fuel, companies that are using renewable energy and other clean sources of power will all have an advantage in that their costs will be reduced. They won't be impacted as much by this evolving regulatory process.
One of the reasons responsible investing has been viewed as more safe today than it was maybe 5 or 10 years ago is there's a bit of a benchmark out there for people to see how these responsible investment indices have played out against their conventional equity benchmarks. So if you look at the largest, most referenced in the world, which is the Dow Jones Sustainability Index, that's turned in 13.5% over the past 5 years as of January 07. And then you compare that to the Dow Jones Global Industrial, which is its equity benchmark, that's turned in 12.4% over the same period. If you look at within the Canadian market, the responsible investment equity funds that exist in the Canadian market, take those funds, compare them to the average Canadian equity fund, and you get the responsible funds turning in about 12.37 versus around 12.25 for the average Canadian equity fund over the last year, and the numbers don't lie. The responsible investments are doing as well or beating the conventional investments. It puts to bed that myth that if you invest in responsible investments, you're going to take a hit on the bottom line.
Well, the era we're going into is going to provide us with, lots of opportunities, but a lot of them are going to be real feel-good things and quite speculative. But what, as a manager, I have to mitigate risk, and I have to look for real companies that are going to survive. Do we understand the business model of a company? Do they have a comparative advantage relative to their peers? What kind of returns has management produced in the past? Are they good at allocating capital? And last but certainly not least, how does this company's valuation in the market compare to its peers, to its historical track record? And from that, we build a risk-return matrix, if you will. And if that's favorable, then it's likely a go.
Sustainability can determine if a company is going to make money or if it's going to lose money. And in the end, in the long term, that's really the central driving force for companies. You look at Goldman Sachs, they just made an investment 2 years ago in a wind energy company for $1 billion, Horizon Wind Energy. And it was thought to be a bit of a risky investment. They didn't know what was going on with the regulatory environment. They sold that investment that they did for $1 billion for $2.2 billion 2 weeks ago. So they made $1.2 billion on that investment.
Part of our portfolio diversity strategy is to reduce risk by ensuring that we have investments in sectors that are growing, sectors that have good growth prospects. And by looking deeply, looking sort of much further than just at the surface, we're able to find companies in all sectors.
An investor is not restricted in terms of investment opportunities, and we think we'll actually be in the mainstream of a new opportunity for investors, and I think our results show that to date.
There's all sorts of examples on the reporting side where you can look at companies and you can see examples of they're doing something good on the environment and they're doing something good at the bottom line at the same time. There's one report that comes out that I like to look at. It's called Carbon Down, Profits Up. And you can look across the board. Catalyst Paper, based in BC, they've reduced their greenhouse gas emissions by 71%. And over that period, they obtained net savings of $4.3 million cumulative every year. BP, who famously obtained their Kyoto target and then some, they've reduced their greenhouse gas emissions by 10%. At the same time, they saved $1 billion, and that's net. So they've added $1 billion to the bottom line, and they've decreased their greenhouse gas emissions by 10%. There's huge opportunities and huge potentials for reducing costs. Companies are doing it around the world, and they're saving money, and the investment community is happy. So that's happening because it's also boosting their returns.
The investment process at Inhance represents the synergy, really, of financial analysis with total environmental, social, and governance analysis. And the world's new focus on environmental and climate change is really proof positive that we are on the leading edge of what will be the norm in investment management for years to come.
You don't have to choose between return and responsibility. Inhance Mutual Funds delivers both.